Inventory is what the business buys to sell to customers. So the total amount of what you have purchased is either going to be sold to your customers. If it's not sold, then it's still left on the shelf available to sell. It's still going to be an asset for our business. So the total amount of inventory purchased should be equal to the cost of sales, which is the cost of what we have sold, plus the value of our ending inventory, which is what is left. So let me explain this with an example. Let's say I purchased 100 items of inventory, identical items. Each one costs $1 each. So I have spent $100 to buy all of my inventory. Now at the end of the month, I have a look on my shelves to see how much do I have left. And I can see that there are 40 items left. Now, because each one cost $1, then I can use that to calculate my ending inventory. So this will be my ending inventory, an asset on the balance sheet. So how many did I sell? If I purchased 100 and there's only 40 left, this means I must have sold 60 items. Each one cost me $1 to buy, so my cost of sales is $60. And the 40 plus the 60 equals to the 100. This 60 is going to be my expense called cost of sales. This 40 is going to be my ending inventory. So that's nice and simple. Let's have a look at what happens in a slightly more complicated situation. When I purchased the inventory, I didn't buy them all at once. I bought 30 items for $1, and then I bought another 70 items, and this time when I bought them, the price had increased, and now it's $1.10 each. So I have 40 items left, but what number do I put here? Do I put $1 here, or do I put $1.10? And I've sold 60 items. What number do I put here? Again, is it $1 or $1.10? These are identical items. You can't tell the difference between the $1 items and the $1.10 items. So how do we work out these numbers for our financial statements, the ending inventory and the cost of sales? This is the question that we have here. How do we find the value of ending inventory and cost of goods sold at the end of the period when we have a change in the cost? Well, this is our solution. There are 4 different inventory costing methods. The first one is called specific identification, and this is what you would use for unique items like antique jewelry or expensive luxury cars. In this case, you would just know exactly the cost for each unique piece of item. Then in point 2, 3, and 4, we have some assumptions that we make, and these assumptions will give us those cost amounts. FIFO method is first in, first out. This is the assumption that the first unit of inventory purchased is the one you sell first. This is what you would use for something like fresh fruit and vegetables and for milk. When you see in the supermarket, which milk do they sell first? The first milk purchased is the oldest milk, and they want to sell that first to customers before it expires. LIFO method is the opposite method, it calculates cost of goods sold based on the assumption that the last unit of inventory purchased is sold first. So this might be for things like hardware or stationery or books, where it doesn't really matter which one gets sold first. And maybe you just make a pile of these items, and the last one you bought is the one that's on the top. The last one that the business has bought is going to get sold first to the customer. Then our next one is called the moving average method. And this is where you just calculate the average. Now, to calculate the average, this is the formula. It's the cost of goods available for sale. Now, cost of goods available for sale is the cost of everything you've purchased. And then you divide that by how many units did you purchase. So in that case, it would be 100 units.